Welcome to the podcast from Morningstar UK, the leading provider of investment news, views and analysis. This week, we're focusing on the UK and European markets and how politics have impacted those stock markets. UK stocks have fallen from favour as concerns build around Brexit. But our first guest, James Henderson, manager of the Lowland Investment Trust, welcomes the dip as it has provided opportunity for him to pick up income stocks cheap.
Hello, James.
Hello.
So income is the name of the game. You upped the dividend in December, much to shareholders' delight. But income is one of those things that I imagine at this stage in the cycle is becoming a little more difficult to find.
Well, in some senses it is, because the favourite income stocks have been favourites for a while. But for me it isn't at the moment. Quite a lot of the UK has fallen out of favour, and this is throwing up reasonably high yielding shares that will pay the dividend. They aren't shares that are... They've probably got some problems around them, or some perceived problems around them, but they are the higher yielding shares. So I'm slowly buying into some of those, and I've increased the gearing at Lowland. And the thing about increasing the gearing is that it increases the earnings, because we're borrowing this money at 1.25%, and I'm buying shares like Severn Trent that are yielding more than 6. So actually there's a slight embarrassment of earnings and income at the moment coming through. I will have to keep calm and say, no, we shouldn't, 8% increase will be plenty. Actually the earnings could come through at more than that, because as we move the gearing up towards 15% from 6 or 7, borrowing at 1.25, buying things yielding 6, your revenue account improves quite a lot. I
think that's a really important point to make about the UK being out of favour. We've had several Bank of Merrill Lynch, etc. studies showing that for foreign investors, the UK is incredibly unloved. They're very nervous about Brexit and even a Corbyn government. What makes you think that perhaps those fears are unfounded and there still remains a compelling place to be?
Well, you're right. The foreign investor, it's the market he hates the most. The UK consumer is having a really difficult time. But these things Brexit happened in 18 months ago. The foreign investor has been selling down in that time. The UK investor has been also selling down. And we've reached a point now where valuations are remarkably low in comparison to overseas valuations. And sometimes people are overdoing the gloom. Good quality companies with excellent products that are selling some of their product overseas will get through whatever Brexit throws at them. Those companies have to have something exceptional about them, or they need to have a position in their markets that allows them to go through a more difficult time and come through the other side. But there are those companies, and at the moment the ones that are doing that and growing their dividends, I think will be very good investments in the long term. I think you have to do it slowly. I don't know the answer to how it all works through. I haven't a clue. So I'm just trying to focus on the companies that have got something about their product that makes them truly competitive. And then whatever politicians do, they won't mess them up.
Does that mean that you mentioned there you're looking for global leaders that that happen to be here, that are selling product overseas? Does that mean that you're more nervous about domestically focused stocks, or is it much more about the individual companies?
It's about the individual companies. No, nothing like that. I think that international company hasn't come back in the same way. So there are companies what have I been buying? I've been buying Green King, the pub company, of late. It has been difficult, the area, but they are likes are all right at the moment, yet the valuation is low. Then there are companies that are perceived to have political concerns around them. So I've been buying actually something like Severn Trent. It is controversial, but that's why it's when there's a bit of controversy around a company that they become really cheap, and that's, I think, Severn Trent, National Grid are such companies. Something like an infrastructure company like John Lang Infrastructure has also been very weak, again on these worries, political worries as much as Brexit, and now the valuation on that is very low and the yield is high. Do it slowly, nothing dramatic, but on really weak days add a bit. and keep going like that. That's the strategy. You have to be careful about the consumer. In the UK, it is under pressure. But again, if the format is right, they come through the other side.
James, thank you very much.
Thank you.
Up next, JP Morgan's Claverhouse Trust manager Will Meadon says it is understandable that UK equities have fallen from favour, but warns investors against ignoring them completely.
Hello.
Hello.
So UK equities is your bag, but it's not everybody's at the moment. And foreign investors are not very keen on UK equities. Why is this, and are their fears founded or unfounded?
You're right, Emma, that UK equities are pretty unloved at the moment. And to some extent, that's understandable. The politics has been very uncertain. You know, the snap election that was called by Theresa May, where the result went a way that not many expected. Clearly, Brexit is overhanging, but those skies will clear in some form in the next 12 or so months. But I think the mistake investors are making is, if they're neglecting UK stock market completely, is that the UK stock market is not the UK economy. If you look at, for example, the top 100 companies, the FTSE 100 companies, roughly 70% of their earnings come from overseas. So effectively, if you buy the FTSE, you're buying world equities, and now, as you say, you're buying it on a knockdown rating. I mean, the prospective yield on UK equities is more than 4%. Which is the highest of any developed stock market around the world. So there is some bad news or some uncertainty around in terms of politics, but that is, I think, more than reflected in the price, and we can come on to talk about the underlying fundamentals, I think, are still reasonably good for UK PLC.
Because the market with FTSE 100 did fall significantly from the beginning of the year down to sort of, I think the low was March the 27th, but it has come up again since then. So are people sort of being overly pessimistic and just taking that snapshot and failing to recognise that actually, as you say, the fundamentals are strong? Yes,
you're right, but it isn't just the UK stock market that's been volatile this year. The world equities sold off for a number of reasons at the start of the year, not least of which there were some very substantial profits to take from the year before. But UK equities did bounce very strongly in April. I think the market was up roughly 6%, and again, it was one of the best performing markets, if not the best performing market in that month. So there's a lot of volatility, but I think as professional and indeed private investors, we ought to try and look through that and take a view of whether equities, in this case UK equities, are good value on a medium-term view, and I think they are. That's why my investment trust, Claverhouse Investment Trust, is geared. And the UK stock market now is roughly the level it was at the start of the year. But meantime, you're getting this very good yield along the way, so you're being paid to wait.
And what is it about the fundamentals that you continue to think, and the valuation that you continue to think is compelling?
Well, it varies from company to company, but on average, if you look at the reporting season that's taking place at the moment, companies on average are beating analysts' expectations. So current trading, it varies from company to company, is going generally pretty well. Balance sheets are in a pretty good shape. Average debt has come down for UK PLC each of the last 3 years. You're getting a very good dividend along the way as well from a lot of companies, some of them paying special dividends. So I think that combination makes UK equities quite attractive in these circumstances. But investors have to learn with accepting some volatility, which they didn't have the year before. It was a very easy ride in 2017.
And finally, how much does currency play into this? Because a lot of the returns in 2017 from UK equities were driven by lower sterling ever since the Brexit vote, really. But sterling has started to come up a bit. Is that going to impact the FTSE too much?
The currency was quite strong. Sterling currency was quite strong at the start of the year. It was partly a function of dollar weakness. But in fact, the last 4 or 5 weeks, the sterling has started to weaken again. So it's now sort of 136 against the dollar, having been 143, 144. And look what happened when the currency weakened. The stock market went up because of the translation of those overseas earnings and some dividends paid in dollars. So the currency is important, but I don't think our investment stance should be predicated on where the currency is going. We don't, in Claverhouse Investment Trust, try and predict where sterling is going, although I do think at this level it's pretty competitive.
William, thank you very much.
Pleasure.
Has Europe reached its peak? Is this as good as it's going to get? Sam Morse, manager of the Fidelity European Values Fund, is up next to discuss investment conditions in Europe and where there is still value left in the market.
Hello, Sam.
Hi.
So we were talking before the cameras rolled about interest rates, and I thought a very interesting point that you made is that European bonds may not be rising anytime soon, that is, interest rates. But that doesn't mean that European equities are not affected by the general rise in interest rates from across the pond, because this is a very global market, isn't it?
Absolutely. I mean, I'm investing in European companies, and European companies these days are as global as UK companies or American companies. I mean, less than 50% of the earnings of European companies now comes from Europe itself. And, global markets are very synchronized. So, we tend to find that what happens in the US has a major impact on our markets here.
And that is because, on the whole, asset prices have been propped up by fantastic amounts of QE and low interest rates. And with that being taken away, that then creates concerns about what it means for those asset classes that have been propped up.
Yeah, I mean, I think in 2017 we saw very strong markets. And I think that was largely driven by a big improvement, certainly in Europe, in terms of earnings growth and dividend growth. So the fundamentals have been strong. And I think there are some questions. This year has obviously got off to a slightly more difficult start. We've seen a lot more volatility in the market. And there are some questions from an earnings point of view whether this is as good as it gets for corporates in general. It's interesting, we do a survey every year where our analysts ask the corporates they invest in how they see the outlook in terms of earnings growth, in terms of capital spending, etc. And this year's survey was extremely positive. So positive that actually it was titled "As Good as It Gets?" ? And I think as seasoned investors, we're always a little bit wary when corporates are confident, when there's a lot of M&A around, etc., that maybe it is as good as it gets, and that the next chapter will not be as exciting.
Having said that, a lot of investing at the moment is to do with relative valuations. How do things look expensive or cheap compared to others?
Yes.
And Europe does still look, on that basis, quite a compelling investment.
Yes, it does. And I think it's fair to say that with the recent pullback, the PE, the aggregate PE of the market is now more in line with its historic averages, perhaps if you include the TMT boom. But I think, one concern on that front is that two things that have, as you mentioned before, supported the market greatly over the last decade or so is the fact that alternative investments, bond yields, for instance, have been extremely low. And also, obviously, there's been immense liquidity as a result of the quantitative easing programs, around the world. And I guess that one of the main concerns for investors that's perhaps led to this volatility year to date is that those two crutches, so to speak, are slowly being removed.
Now, as an equity investor, you don't perhaps have the tools at your disposal that a multi-asset investor who's feeling cautious might do, which is to move everything into gold and cash. So what do you do as an equity investor to proceed with caution?
Yes. Well, we always advise our clients not to try to time the market. And I personally, when running my funds, do not try to time the market. So I will stay fully invested in both the funds. But it does have an impact on my stock selection. And really what I mean by that is that I think now, at this stage in the cycle, it's prudent to assume that I invest on a 3 to 5 year horizon. I think it's prudent to assume that on a 3 to 5 year horizon, we will have both an economic downturn and probably a stock market downturn as well. So when selecting companies, it's very important, I think, to put that in your modelling in terms of deciding whether this is a good company to hold over the next 3 to 5 years or not. And maybe some of those companies that look very cheap right now, perhaps in the auto space or the banks, may not prove as cheap if we have a cycle like that. Whereas companies that perhaps on the surface look a bit more expensive, some of the consumer staples or healthcare companies, might actually look a lot cheaper if you build that sort of a downturn into the next 3 to 5 years.
Sam, thank you very much.
It's my pleasure.
Our next guest is Ollie Russ, manager of the Lowland Trust European Enhanced Income Fund. Ollie feels that Europe has never looked better and is in great shape, so equity investors should make the most of it.
Hello, Ollie.
Hi there.
So you said to me just now that you think the world, specifically in Europe, is in a better place than it has been for quite some time. What did you mean by that?
Well, of course, everyone knows about the great financial crash or crisis of almost 10 years ago now. The US and Europe were caught up in that, but perhaps forgotten is just how well correlated before that US and Europe were. Since that time, of course, the US has gone on to all-time earnings highs, but Europe hasn't, because as soon as we came out of the great financial crash, we went straight into the Eurozone crisis, which was linked but not quite the same. It's only really over the last year or so that we finally emerged from that Eurozone crisis with really the Italian banking crisis that never quite happened. That was really probably the last aftershock for Europe of the crash, and now we're beginning to get out the other side.
And what about fundamentals? Because for a while, not only was the economic picture looking a bit clouded for Europe, but earnings were lagging as well. But that has started to change, hasn't it?
Last year was a fundamental change in trend for European earnings. So before that, for the previous 6 years, really, analysts always expected double-digit earnings growth. But by the time we got to the end of the year, we had nothing or less than nothing. So really, even now, European earnings are quite a long way below their prior peak that we saw in 2008. But last year, there was a fundamental change in trend. We got almost double-digit earnings growth out of Europe, which is almost unheard of now, and it looks like we might do almost the same again this year.
Not to dwell too much on the macro and the negative, but we're very obsessed here in London about Brexit and what the implications are going to be for the UK. But of course, Europe does an incredible amount of trade with the UK. It's not just Europe, not just the UK that's at risk from the Brexit fallout. As a European equities manager, are you concerned by, if we have our worst case scenario, how that impacts European companies?
In aggregate, there's quite a bit of trade, obviously, between the UK and Europe, but it's not that significant for most European countries, apart from maybe Ireland. So I don't think it's going to have too much of an impact. And I think the company's belief at the moment is that things will carry on pretty much as they are now, realistically.
So economy's looking better, Brexit's not a concern, earnings are rising. What else is there to be positive? Are there particular pockets where you're seeing great opportunities?
At the moment, in terms of valuations in the market, I think there's been, over the last really decade, a very strong run for growth over value, which we've seen across markets. And the question will be, when does that start to reverse? When does value come back into favour? And it's a big question for us, of course, on the European income side, because we do have a value tilt, very much so. Financials, big part of value in Europe as well, and a big part of our funds. So they're looking particularly cheap at the moment, a bit unregarded, perhaps not quite so glamorous as some of the tech stocks that we see in the States, but actually phenomenally good value.
Quite sensitive, though, financials to interest rate movements, not just in Europe, but of course over in the US as well, because companies are global. How much does that sort of play into your analysis? They're very well correlated, actually, with the direction of US interest rates, 10-year in particular, perhaps more so even than the European equivalents. They're very sensitive to what's going on in US rates. We think the direction of US rates from here obviously is starting to drift higher now. I think people have got round to the idea now we're sort of 3% and just briefly above 3% on the US 10-year. People can see the direction of travel. So that's clear in America. Isn't so clear in Europe. Really, rates haven't gone up much at all, if anything, this year. But by the autumn, of course, the ECB will wind down its QE programme. It's one of the last still going. The Americans are doing quantitative tightening effectively already. So we don't know what impact that's going to have in Europe, but probably volatility will go up. But also, I think yields will go up, government yields, bond yields generally. Ollie, thank you very much. Pleasure, thank you.
Up next, Nomura's Global Dynamic Bond Fund Manager Richard Hodges says that bond market investors should listen to the guidance given by central banks to avoid the shock of interest rate rises. Hello, Dickie.
Hi, thank you.
So on the walk to the studio, you described this as the strangest market environment you have ever known as an investor. What did you mean by that?
Well, I mean, a lot of the market seems to be dislocated from each other. And if you're looking at the volatility of different asset classes, they represent volatility at different times. There's no coordination. And I think that's down to the uncertainty with regard to the future of central bank and the monetary policies, and also with regard to quantitative easing. And as we've become welcome or we're used to understand, quantitating this year from the European Central Bank will be coming to an end.
And where is there a little bit of certainty? Because it seems to be that the Fed will raise rates. That seems to be an understanding. But the speed and the level of those raises is where there begins to be more uncertainty.
I think so. This was demonstrated very late last year. Bond markets and interest rate markets were only discounting a little over one interest rate rise at the beginning of November last year. where the Federal Reserve had been consistently telling us there will be 3 interest rate rises during 2018. And indeed, at the last March report FOMC meeting, the Federal Reserve, Chairman Powell was telling us that we are indeed going to have 3 interest rate rises and that there would possibly be more moving into 2019. Now, the market has actually fully discounted this possibility now. So what we're looking for is more indication of where we're going to see growth and where we're going to see market evolution over the course of the remaining of 2018 and into 19.
So is it maybe, as you seem to suggest, a bit more just about trusting what they're saying will be the truth?
Yes, and sometimes it's very difficult to trust what a central banker is saying. In an age where they want to be transparent, to give some certainty to the markets and to suppress volatility, we have 1 or 2 weak numbers that come out of the UK economy, for instance, and suddenly expectations of an interest rate rise in May of 2018, this month, disappear, and the probability that's priced into markets falls from a 90% probability to only a 20% probability within the space of 1 week. So transparency is good, but consistency is something that markets need to actually value assets from.
As a global and dynamic bond fund manager, you're probably better placed than most in the fixed income space because at least you have a plethora of levers to pull in order to find value. You're not tied to, say, just US corporates, for example. Where are you seeing the best opportunities within that remit?
Well, more historically and more recently, we've capitalised against the rise of interest rates and the rise of government bond yields. And I think it's less certain, and you shouldn't make the mistake, that bond yields are going to move higher during the course of 2018 and 2019 just because central banks have told us that interest rates are going to go higher. I see pockets of value in various different asset classes, from India, some emerging markets, and certainly over the course of the last 3 months, emerging markets have cheapened significantly. So if you're looking somewhere where you can gain some returns during the remainder of 2018, then I'd look into the emerging market space.
Dickie, thank you very much.
My pleasure.
Bond investors know inflation impacts returns. So our next guest, Hermes Fraser-Lundy, is watching US job figures and the oil price closely to gain insight.
Hello, Fraser.
Hi.
So I don't want to sound like a broken record because last time you sat on that chair, we talked about US Treasury bonds. But they are, yet again, quite an interesting concept because there are increasing concerns about inflation from some parts of the market and the impact this will have on the Fed and the Fed's decisions and the impact that will go on to have on the wider bond market. So I suppose the first question is, are you concerned about inflation?
Well, as a credit guy, we're always concerned about everything. But I would say that the signals being given by the Treasury market right now are to some extent conflicting with what you see in other markets, particularly on the equity sides. You've got the Fed's intending on raising rates several times in the next couple of years, and yet the long end of Treasury curves are telling you a different story with regards to long-term confidence in the economy and some potential signals about the importance of stability around the dollar. And you've seen certainly in the last few weeks in particular what a bit of dollar strength, and I do say a bit because we're not far away from unchanged on the year now, has done to the sentiment in the emerging market credit space. So it really does underpin everything, which is why people like me are glued to inflation all day long.
And when you say you're glued to inflation, are there particular flags that you're looking for, like, for example, the US jobs figures we've had recently?
Yes, and we're also very focused right now on the oil market and other spot commodities. We have big news this evening, one way or the other, from Trump, I think, with regards to Iran, and that is fueling potential inflation via the commodity market, but it's also fueling added geopolitical risk. And I think that is what is keeping us in this new volatility regime that we're in since that volatility shock in the first quarter. It now seems that we are not returning back to those very low levels for the foreseeable future. And again, we need to price that in from a credit perspective.
And so we are in this new environment, as you suggest. We are in an environment where the Fed is making the raises that it suggests it will this year, and volatility has returned. So how do you, as a credit investor, reflect that in your portfolio?
Well, I think there's a lot of discussion around how late cycle we are or not in the market right now. And I think that within credit, it's difficult to say that we are very late cycle because of the sectoral makeup of the market. It tends to be a mixture of very cyclical sectors, a lot of whom nearly died a couple of years ago in the energy crisis. And then a lot of things that arguably are being disrupted right now. So healthcare, autos, telecom. None of these sectors to me seem particularly late cycle. In fact, if anything, they are behaving quite defensively. That's a very different market to what's going on in equities, which is very tech-driven and therefore quite shareholder-friendly. So from that perspective, I think you're likely to get more attractive risk-adjusted return than you might expect from cyclical credit today than maybe in previous cycles. Having said that, covenant weakness is an issue for us, and I think that it has changed the risk-rewards profile of low-quality credit. Essentially, if you're going to get it wrong now, because of the optionality being held so tightly by the sponsors or indeed the companies, the lien that you have on assets, or in fact the assets in the box, when it really comes down to a default situation, is likely to be a lot lower in terms of recovery than you've seen in previous cycles. And at the same time, convexity in the market right now remains pretty unattractive given how short call prices are. So I think it's hard to argue that it's a sensible time in the market to be reaching down in credit quality, but I'm more than happy to take a more pro-cyclical approach because of the ideas I mentioned earlier. The other thing that makes me quite constructive right now is that we are still in a search for yield environment because ultimately yields are pretty low, especially at the front end of curves. And so I think there's a lot to be said for making sure that you're optimizing what point in the curve you're accessing credit at, because a lot of people seem to be dipping their toe half in and they don't really want to be there, which is understandable because things are relatively expensive here, as all markets are. But if you are able to access credit longer out the curve without necessarily taking an undue amount of interest rate risk, I think that's where the real opportunity is, because it's kind of under-owned and the roll-down contribution to your carry is significant here because curves are so steep. So I would say that lending for longer to better quality companies rather than shorter to lower quality should be a mantra for this year.
Fraser, thank you very much.
Thank you.
Next up, we have Baring Emerging Europe Fund Manager Matthias Siller, who suggests investing in financial stocks to benefit from increasing wealth in Eastern Europe.
Hello, Matthias.
Hello, hi.
So I saw an interesting report today, this week. The World Bank has come out and predicted that by 2025, Eastern European countries, including Romania, Poland and Hungary, will be richer than those Southern European counterparts, such as Italy. What is driving this rise in GDP per capita?
Well, from my perspective, it will be investment-led. So these companies have been very friendly and have been very successful towards foreign investment. And they also see rising productivity gains on the back of that. So these countries, even though you see domestic consumption increasing on the back of household income growth, people get richer. There are productivity gains that keep them extremely competitive on an international level, probably more competitive than other parts of Europe. And I think that is the key reason why we will see wealth increasing in those countries.
And of course, this is good news for the economies of those countries and good news for the individuals who live in those countries. But it's also got to be good news for people who invest in the companies listed there, right?
Absolutely. We think it's a win-win situation here where households do participate in these economic gains, and that could very well translate into a positive backdrop for investors, as not only exports go up, also domestic consumption should increase on the back of that.
And what sectors or what kind of companies can you invest in order to benefit and to profit from this kind of rise?
I think what stands out is the financial sector here. It's I think it's very clear to see that needs of households, but also companies increase more and more with regards to savings, with regards to insurance products, and so on. So we think that indeed the financial sector should benefit from this development. And also here there are productivity gains as more and more of the financial sector will migrate to the internet.
And of course, the financial sector, certainly in Western Europe, I know less about Eastern European banks, but have been quite beaten up over the last couple of years. I can think of some German banks that have not fared too well. Does this mean that it's at a quite attractive valuation at the moment for stock pickers such as yourself?
Valuation is supportive, I would say. But what is more important here is that the financial sector is in a very, very good health, contrary to the financial sector in the countries you just mentioned. So what we would focus on is more the qualitative aspect of the financial sector in the new EU member states such as Poland or Romania, where we see, and we think this is going to be a main differentiator. The balance sheets are in order, and we do see that banks are investing into becoming future-proof and to defend their market share against international competition.
Matthias, thank you very much.
You're welcome. Thank you.
Our final guest is Emily Fletcher, co-manager of the BlackRock Frontiers Fund, who reveals which of the forgotten 40 stock markets offers the best risk-reduced returns.
Hello.
Good morning.
So what is meant by Frontiers? Because for you and this fund, it's recently become a lot broader a remit, hasn't it?
Sure, exactly. Thank you. So when we think about frontiers, I mean, really, you have the developed markets, which I think are very distinct to emerging and frontier. And then you have really the rest of the world, the emerging and the frontier markets. And within that, we don't invest in the top 8 emerging markets, the largest 8, which represents around 85% of the emerging market benchmark. We think it's therefore about 85% of where most people are invested in emerging markets, 85% of people's time. And therefore, really, the rest, we name sort of the forgotten 40, and sub-markets. That's what we think is really interesting. The things that people generally overlook, where we think that correlations between the markets are lower. Correlation, for example, between any stock in those top 8 markets, median pairwise correlation is 0.6. In our markets, that comes down to 0.1, so much lower correlations. And we think forgotten. So therefore, interesting markets because they're generally overlooked by your typical investor who doesn't really have the time or the scale to be able to focus on these small markets, which take a lot more time. And therefore, there's the opportunities for alpha in these less efficient markets. So we focus on those smaller emerging and frontier markets.
And one of those which you've recently become more positive on is Egypt. And I think that's quite an interesting case study because it does have connotations, Egypt, which have recently been quite negative. And that also is quite typical of frontier market investing. There is much more macro-political noise and considerations than, say, if you were a US equity investor.
There is, and it is important to have a good understanding of the macro in all of the countries we invest in. And the reason is because we're dollar investors. So you wouldn't want me to turn around at the end of the year and say, I've done fantastically well, your fund's up at 200% in Kwacha. What's important is how the fund has done in dollars. So therefore, the understanding of not only what the equity market is going to do, but the fixed income market and also the currency market is hugely important when investing in these smaller emerging and frontier countries. So to take Egypt as an example, when did we start to get interested in Egypt? Well, it was after the very substantial currency devaluation that Egypt saw around 18 months to 2 years ago, which then meant the currency is now at a sustainable level. At the same time, the government has also stepped in to do substantial things to address what was then a huge fiscal deficit. And as a result of that, they've now put their debt, or they should be putting their debt, on a sustainable path. So debt to GDP, having peaked at around 110%, should come down to around 80% over the next 2 to 3 years. Still a high level, but something that I think becomes then sustainable for them to be able to grow off. Why are we interested in Egypt at the moment? Because we think that domestic activity can start to accelerate from here, and we think that should be positive for equity prices.
And of course you are a bottom-up stock picker, but as you suggest there is this overlay of macro because of the dollar considerations, because the geopolitical rumblings in some of these regions can be far louder than in developed markets. Are there any particular countries for those reasons that you just say, actually, we're going to leave for now?
Yes. I mean, at the moment, our view is on emerging markets. We're broadly positive with a couple of exceptions. And the exceptions for me at the moment would be the Philippines, would be Turkey, and would be Pakistan. Those are all countries that we are either avoiding or sometimes, in some examples, have shorts in our portfolio for the reasons that we think that the economies are overheating, or we think the currencies are substantially overvalued. And we think that those problems will manifest, in what happens in the equity market. And you will lose money in when the currencies get very overheated in our markets and you do have a big devaluation, well, the equity market tends to be positively correlated and you lose money both on the currency and the equity market. So those, at the moment, are a big avoid for us.
Emily, thank you very much.
Pleasure.
And that's the end of this edition. We hope you enjoyed this programme. From everyone here at Morningstar UK, thanks for listening.